Want dependable income that grows year after year, without chasing risky yields? Today I'll show 5 dividend aristocrats that belong in a serious income portfolio in 2025, and I'll give you the practical checklist to vet them yourself. Stick around. I'll also show how to size positions so your dividends actually pay your bills, not just your ego. Before a single ticker, one question. Why do investors worship dividend aristocrats? Dividend aristocrats are S&P 500 companies that have raised dividends for 25+ consecutive years. That streak forces discipline, steady cash generation, conservative capital allocation, and management focused on shareholders. In uncertain markets, aristocrats tend to be anchors, not fireworks. For beginners, they're a great place to learn income investing. For experienced investors, they're the dependable backbone of a portfolio. Value movement. Think of aristocrats as companies that have passed multiple economic cycles. That's not a guarantee, it's a strong signal. Pick one, a snack and beverage giant that pays you while the world eats. PepsiCo operates in defensive consumer staples, snacks, beverages, grocery brands people buy regardless of the cycle. That steady demand helps maintain cash flow, critical for dividend sustainability. Why it's attractive: broad product portfolio, global reach, pricing power in inflationary environments, and a long history of raising dividends. Use PepsiCo if you want inflation protection with steady dividend growth. Practical note: check payout ratio and FCF. Ideally, you want companies that can pay today's dividend without borrowing. From snacks to stores, our next aristocrat proves retail can also pay. Retail that survived Amazon and still raises dividends. Target is a modern retailer that pivoted to omni-channel and private label strength. Unlike cyclical mall retailers, Target's value proposition is everyday low price plus curated assortment, which gives it resilience. Why consider Target? Consistent same-store sales improvements, growing e-commerce integration, and a shareholder-friendly capital allocation, dividends plus buybacks. For investors, Target is a way to capture consumer spending with income. Practical note: watch margin trends and inventory management. Those drive free cash flow and therefore dividend safety. Next, we move into industrial strength. An industrial name you may not say every day, but your portfolio should. Dover is a diversified industrial company with multiple niche businesses, from engineered systems to pumps and printing equipment. The benefit of a diversified industrial platform is earnings resilience and steady cash generation across cycles. Dover's long dividend history and specialized businesses can deliver moderate growth plus dividends, a blend of income and capital appreciation. Practical note: for industrials, monitor backlog, order trends and end market exposure, energy versus healthcare, etc. Now let's move to a distribution classic. Cars break and someone needs the parts. That's where GPC wins. Genuine Parts Company distributes automotive and industrial parts globally. Distribution businesses often have reliable cash flows, long customer relationships, and defensive demand even in slow growth periods. GPC is a classic aristocrat. Steady dividend increases, strong aftermarket demand, and a model that's hard to disrupt. If you want predictable payouts from an essential service, this is the kind of business to consider. Practical note: keep an eye on auto cycles and replacement parts demand, and FX exposure if you're a global investor. Finally, financials that pay you to stay calm. Insurance, maybe not sexy, but it pays dividends very reliably. Cincinnati Financial is a property and casualty insurer with a conservative underwriting model and steady investment income. Insurers can be excellent dividend payers because they collect premiums and invest reserves. If underwriting is disciplined, dividend streams are very durable. Cincinnati has proven conservative management, which is exactly what you want in a long-term income holding. Practical note: watch combined ratio and investment yield. Those determine free cash flow for dividends. Now that you know 5 quality aristocrats, how do you choose and size them? Don't buy because a name looks safe. Use a checklist. Here's the exact checklist I use. Use this 5-point checklist before you buy any aristocrat. 1. Dividend streak plus growth rate. 25+ years is the entry ticket. Check the recent growth rate to see if the company is still accelerating payouts. 2. Payout ratio, dividends, earnings, and dividends, FCF. Sustainable payout ratios typically sit comfortably below 80% for risky sectors. For stable sectors, lower is better. 3. Free cash flow and balance sheet. Positive FCF and manageable debt levels support payouts during stress. 4. Business quality and pricing power. Brands, niche positions, or contracts that allow price increases protect margins. 5. Valuation and entry price. A great company can be a poor investment at the wrong price. Compare PE and PEG versus history and peers. Sizing guidance. For most investors, treat each Aristocrat as a core holding. 3-8% of your portfolio per position, so a 5-stock core equals approximately 15-40% of your portfolio depending on risk appetite. More aggressive investors may overweight to 8-10% if conviction is high, but never allocate so much that a single dividend cut breaks your income plan. Practical portfolio tips. Use DRIPs to compound small payouts. For taxable accounts, consider tax-efficient wrappers, IRAs, ISAs, to avoid losing yield to dividend taxes. 3 mistakes I see over and over. Avoid these and your dividend income will thank you. Mistake 1. Chasing headline yields. High yield alone is not safety. Mistake 2. Ignoring payout coverage and debt. Yields funded by debt are fragile. Mistake 3. Overconcentration. Even aristocrats can stumble sectorally. Risk management. Rebalance annually, harvest winners, trim to rebuy beaten-down quality names and hold a cash buffer to buy on dips. If you build an income portfolio around quality, time is on your side. Recap. Aristocrats like PepsiCo, Target, Dover, Genuine Parts, and Cincinnati Financial aren't shiny, but they're dependable. And dependability compounds. Use the checklist, size positions sensibly, and let dividends do the heavy lifting. Next episode, I'll show you high-yield picks that pay over 5%, and how to separate the traps from the treasures. Don't miss it. If this helped you, smash the like button, subscribe to AmosFinance, where insight is turned into action, and drop your top dividend pick in the comments. I read them all.